Amazon still looks unstoppable. The company posts billions in profits every quarter. Investors trust its brand and business model. Wall Street analysts often praise Amazon for its growth and dominance. CEO Andy Jassy says Amazon is healthier and more focused than ever. The numbers seem to prove him right. Last year, Amazon's revenue shot past $570 billion. Its cloud division, AWS, remains a cash machine. The Prime membership base is huge and loyal. Millions of people worldwide use Amazon for almost everything, from electronics to groceries to streaming. In the US, Amazon still controls about 38% of online retail sales. For most shoppers, it's the default place to buy. But behind this strong image, there are cracks. Some investors have started to ask tough questions. Growth in Amazon's core US retail business is slowing. Some of its profit comes from cost cutting, not from new shoppers. The cost of doing business in America keeps rising, and Amazon's rivals are getting smarter and quicker every year. So, while the giant stands tall, the ground beneath it is shifting. The company's future, once seen as secure, is now tied to new dangers, especially from aggressive Chinese competitors. Two names now haunt Amazon's dreams: TEMU and AliExpress. Both are Chinese e-commerce platforms. Both have exploded in popularity in the US and Europe. TEMU, owned by PDD Holdings, was almost unknown before 2023. Today, it's one of the fastest-growing shopping apps in America. It's hard to spend an hour online without seeing a TEMU ad. "Shop like a billionaire," their slogan says. AliExpress, a part of Alibaba, has been around longer, but it's recently ramped up its US push. It offers almost everything Amazon does, often for much less. These platforms can sell socks for $1, gadgets for just a few bucks, and even home decor for under 10. Their secret? Direct shipping from factories in China, no middlemen, no big warehouses, lower costs. TEMU and AliExpress use aggressive marketing. Influencers show off cheap hauls, and social media is full of viral unboxing videos. Their apps are slick and easy to use. They offer free shipping on almost everything, even for tiny orders. Delivery takes longer than Amazon Prime, but customers seem willing to wait if the price is right. The result? Millions of Americans are trying these apps. Many are coming back for more. This is more than a trend, it's a real shift in shopping habits, and it spells trouble for Amazon. TEMU and AliExpress aren't just popular, they're winning real market share. In 2024, TEMU became the most downloaded shopping app in the US. Its monthly active users soared past 50 million. AliExpress is following close behind. Together, they control almost 10% of all US cross-border e-commerce sales. That number is rising fast. Why are shoppers switching? The math is simple. Prices on Chinese platforms are sometimes 50% lower than Amazon's for the same product. Shoppers can find trendy clothes, electronics, and home goods for a fraction of typical US prices. For families on tight budgets, this is a game changer. The low prices come at a cost, longer shipping times. But many consumers don't mind waiting 2 weeks if it means saving money. Younger shoppers especially are willing to trade speed for value. Social media helps spread the word, with TikTok and Instagram filled with TEMU hauls and AliExpress reviews. It's not just individuals. Small businesses are using these platforms to source cheap supplies and resell them locally. This is helping TEMU and AliExpress expand even faster. Amazon is losing ground not just in sales but in the loyalty of both consumers and small sellers. Amazon's greatest strength, the US market, is now its biggest vulnerability. The American consumer is the world's most valuable online shopper. If Amazon loses even a small slice of this market, it risks losing billions in profits. TEMU and AliExpress know this, and they are targeting US shoppers with discounts and constant promotions. The risk is not just in the numbers. Amazon's brand was built on trust, speed, and reliability. But as people get used to shopping on TEMU and AliExpress, that trust is being challenged. If shoppers begin to see Amazon as expensive or old-fashioned, its moat weakens. The Prime effect is fading for some consumers, especially as household budgets tighten. Profit margins are at risk too. Amazon's costs are rising. Wages, delivery, and returns all eat into profits. Meanwhile, TEMU and AliExpress keep costs low by shipping direct from China and using cheap labor. They don't have to pay US warehouse workers or delivery drivers. They can undercut Amazon at every turn. If TEMU and AliExpress keep growing, Amazon may have to cut prices or boost advertising, both of which hit profits. Wall Street is starting to notice. Some analysts warn that the days of easy growth are over. Section 5, fighting back Amazon's internal struggles and high costs. So, Amazon isn't giving up. It's pouring billions into logistics, trying to deliver faster and cheaper than ever. The company has invested in new robots, delivery vans, and cutting-edge warehouses. It's also working to expand its own private label products, hoping to match Chinese prices. But, all this comes with a price tag. The cost of labor in the United States keeps climbing. Amazon's big warehouses need thousands of workers. Strikes and union talks are on the rise. Every pay raise or new benefit adds to Amazon's expenses. Meanwhile, TEMU and AliExpress don't have these problems because they operate from China with lower costs. Amazon has tried to fight back by cracking down on counterfeit goods and ensuring quality. But this means more checks, more staff, and more red tape. Chinese platforms are less strict, which lets them move faster and offer more variety. Customers may get what they pay for, but many are fine with cheap, disposable products. Even with all its resources, Amazon finds it hard to win on price. Logistics in the US are expensive and complicated. Competing with TEMU and AliExpress means squeezing margins and taking risks that may not pay off. Section 6. Tariffs, trade politics, and the Trump factor. The battle isn't just about business, it's about politics too. US tariffs on Chinese goods are supposed to make imports more expensive. This should help Amazon, which relies more on US-based fulfillment. But there's a loophole. Packages under $800 shipped directly to shoppers escape most tariffs, a rule called de minimis. TEMU and AliExpress use this loophole to send millions of packages tax-free. Politicians in Washington are starting to notice. Some want to close the loophole to protect American jobs and companies like Amazon. Others argue it keeps prices low for struggling families. The debate is fierce and getting more heated as the 2024 election approaches. Former President Trump has promised to raise tariffs on Chinese goods. He says this will protect American companies and workers. If he wins and follows through, it could hurt TEMU and AliExpress. Prices would rise and Amazon might regain its edge. But higher tariffs could also mean higher prices for all, including Amazon's own imports. The outcome depends on politics, not just business. Amazon's fate could swing with a single policy change in Washington. Section 7. Price wars, innovation, and the Nokia effect. Amazon's business model was always about innovation and scale. Fast delivery, huge selection, and customer trust set it apart. But TEMU and AliExpress don't try to out-innovate Amazon. They just win on price and speed from factory to doorstep. Their business is about scale, not just technology. This is the Nokia effect. Nokia once ruled the phone world with great engineering and a trusted brand. Then cheaper smartphones from China changed the rules. Nokia couldn't cut prices fast enough. It lost the market almost overnight. Amazon could face the same fate if it can't adapt to the new price-first world. Amazon is trying to innovate. It's testing drones, cashierless stores, and buy with Prime for other sites. But these aren't enough to fight a global price war. TEMU and AliExpress have millions of factories behind them. They can flood the market with new products, fast and cheap. If Amazon can't keep up, it risks becoming the next Nokia, still big, but no longer in control. The risk is very real, and Wall Street knows it. Section 8. Wall Street worries, consumer shifts, and Amazon's uncertain future. Investors and lawmakers are watching Amazon's fight closely. Wall Street is worried about slowing growth and shrinking margins. Some analysts say Amazon's best days may be behind it. The government is also asking hard questions about competition and foreign influence in e-commerce. Shopper behavior is changing fast. People are less loyal to brands, more focused on price and variety. Younger buyers raised on social media don't care where something comes from as long as it's cheap and trendy. This shift is global. Amazon's old formula, fast, reliable, but pricey, may not work for a new generation of shoppers. Amazon is trying to shift supply chains, open new markets, and match Chinese prices. But it faces a tough road. TEMU and AliExpress aren't slowing down. They're expanding into Latin America, Europe, and Africa. The battle is now global, and the outcome is uncertain. In the end, Amazon's future may depend less on its own actions and more on politics, tariffs, and global trends. The giant isn't falling, yet. But the world around it is changing faster than ever before.